To analyse the Reserve Bank's comments today, let's bring in here independent economist Warren Hogan, an advisor to Judo Bank, and Westpac's chief economist of its business bank, Bessa Detta. Thank you so much for your time, both of you. Can I just start with you, Bessa? I mean, do you think there was that element of surprise in the statements from the Reserve Bank today?
Look, we thought that the RBA would adopt a cautious tone, even though the recent data had showed a deterioration in economic activity and a faster decline in the rate of inflation. And we think the RBA did strike a cautious tone. However, probably more surprised by the risks being characterised as broadly balanced, nothing in and nothing, anything could be in and anything could be out, as Bullock said in her press conference. But I think when you look at it, I think what they're really doing is pushing back on the chance of a near-term rate cut, and with the insertion of you can't rule out another increase in the accompanying statement, that also suggests that they really want to be convinced that the progress on inflation is sustainable and will continue.
And we're seeing that in that statement, Warren, and that is really, it was very demonstrable, it was there. And that was the part of the statement that might have been expected to have come out, given what we'd seen from the Federal Reserve, given what we'd seen from the Bank of England.
Yeah, and I think that's where markets here will be a bit surprised that the RBA didn't have any kind of pivot, really. I mean, the fact that they've said they could raise rates further is a real shock, and I think it's pouring cold water on all of those rate cut talks from markets and politicians alike. And it reflects the fact that we're 6 months behind everyone else. You can see that in the data. It's been the case for the whole cycle, the last 18 months. And I think it's one of the most important starting points for us talking about rate cuts is seeing rate cuts overseas first. And we're probably going to be at least 3 months, if not 6 months, behind the Fed, the Bank of England, the Bank of Canada, because our cycle's lagging. And of course, we didn't raise rates as much. So we're probably not going to be cutting them as much as these other central banks do. So this is a nice reminder to the market here and to the broader community, particularly given how strong the housing market was on the weekend, that, we're probably going to be at best seeing stable rates this year.
Because there are signs there of a weakening economy. That's what the forecast, because we saw the statement of monetary policy, which we don't normally see with a Reserve Bank interest rates decision. We saw it today. So we can now see the updates to their forecast, some of which are demonstrably weak, aren't they?
They are, and we certainly saw that household consumption is expected to remain very weak, and that's a big part of the real economy. We saw mixed revisions across business investment, but then if we looked at dwelling investment, there were really material downgrades.
Yeah, have a look at this. So previously they had 4.1% growth. Now it's at 0.3% by June 2025. So that is really showing that we've seen construction companies fall over. We know that Australia's housing industry has not enough houses being built. That's showing that that's going to get worse, not better.
Yeah, and I think that's what the forecasts really demonstrate, that it will be harder to deliver another rate rise. The threshold for another rate rise is really high now. But at the same time, they did push against that notion that near-term rate cuts, as Warren was saying earlier as well, they did push against the chance of a near-term rate rise.
Okay,
rate cuts.
One other aspect of this, a lot of people might think, when inflation, and we saw in the forecast there that inflation is going to come back into their target band of 2 to 3%. Michelle Bullock was asked today, is it 2.5% when you start cutting rates? Is it 2? Where is it? And she said, it has to be there, but it has to be sustainably there. We're going to make certain it's not going to bounce back out of the box again. And this is really our inflation rate coming down now, but that's a key right now for people to understand.
Yeah, and in their assumptions, they've got weaker oil prices and a higher Aussie, and that's actually dragged down their inflation numbers for the first half of this year. So they've got inflation falling all the way down to sort of 3.5 by the middle of this year, but then only getting under 3 by the second half of 2025. So they're going to come under some pressure, I think, throughout the first half of the year to be cutting rates, because if their forecast is right, inflation is going to keep coming down. But the point is it's domestic inflation that matters. And all of the disinflation we've seen has been global goods inflation. And of course, in those last CPI numbers, all the domestic inflation indicators are still running at around 4.5. And that's why they can't rule out further rate hikes.
That's what she said. Services inflation is where it's coming from. And somebody asked, what's services inflation? She said, anything you can't drop on your foot is services inflation. But so I want to go to one other point, because much was made about assumptions in where the economy ends up. And we've got something to show you here, which basically is a quote from them, showing basically about interest rates and where they're heading in their assumption. But what, again, Michelle Bullock was at pains to say, look at this, the forecasts are conditioned on a path for the cash rate broadly in line with expectations derived from surveys of professional economists and financial market pricing. We go on, the next part of it's interesting because it basically says the cash rate is assumed to remain around its current level of 4.35% until the middle of 2024 before declining to around 3.2% by the middle of 2026. Here she says, we need an assumption to have our economic modelling. This is not a forecast. This is not a promise. This is just an assumption. It might change. That's really important, isn't it?
It is important. I mean, they're using the assumption of market pricing and also the responses from economists in surveys. And I guess taking into account that those assumptions include rate cuts, they've still got inflation going back into the band in 2026. In underlying terms, or using the trim mean inflation gauge, that happens a bit sooner. But that's a key point, I think.
OK, so does any of what you've seen or heard today change your assumptions or your view as to when interest rates move in Australia?
No, we had thought that rate cuts might come late this year. And based on what we've seen today, which is really ruling out the chance of a near-term rate cut, I think that is still a very good forecast. She does make the point that the data is very important, and so we will need to see the data, particularly the next inflation report, particularly the labour market data and also the GDP report.
And what about you, Warren? Has it changed anything in your mind about where the markets are going?
Yeah, look, I think it does bring in this risk that we get another rate hike. It's not going to be in the next few months because they're going to need to see the economy re-accelerate and, of course, inflation stop falling. But the reason I emphasise to your viewers that we can't forget about this scenario is that's the one that's going to have the biggest impact. If they're back in hiking in the middle of the year, and if the Fed's doing it, what it's going to do to equity markets, what it's going to do to property markets will be significant. If we just get what everyone's thinking, a rate cut later in the year, that's all fine. That's a good outcome. But if we get rate hikes from the Fed, from the Bank of England, from the RBA in the middle of the year, that's going to be a big shock.
So you say that's a warning, but is it what you think will happen?
I think it's a 1 in 4, maybe 1 in 3 chance of being the way it plays out. We don't know. We're going to be watching the data, but we saw the US payrolls on Friday night. They were strong. And if our economy does pick up, then the RBA may have no choice, and that's, of course, why they have not ruled out rate hikes.
So Warren Hogan and Bess and Data, thank you so much for your time on the program today and the analysis as well. Many thanks.
Thanks, Ross.